Shveta Arya, who's the Managing Director, Cummins India, who's joining us. Shweta, hi. Many congratulations on another strong quarter. Take us through the key drivers and how much of margin improvement is due to favorable product mix versus cost-saving initiatives?
So the growth in this quarter was driven by power generation in the domestic market for us across the CPCB 4 Plus range and then in the data center range as well. So for the data center specifically in this particular quarter, there was good orders that we could execute. These are some complex executions, but we were able to manage those well. So those, and then the aftermarket, which has been growing for a while for us across the board, different segments. And exports also came in better, again, due to good execution, good order intake. So across these three is where we got our growth. From a margin perspective, cost reduction efforts, yes, product mix, but I would largely also say that the volume leverage. This quarter, we had very good volumes. And so that helps us leverage our operating expenses pretty well. So all of those led to the margin improvement.
Okay, so several factors aided margin improvement in the quarter gone by. Ms. Arya, afternoon, Ashesha this side. In your call, you also mentioned that order intake continues to soften in the quarter gone by, and this was because of channel inventory correction. If you can tell us how large is this inventory correction, and by when do you expect this to normalize? Is it likely to happen in the third quarter itself?
So this I mentioned about exports that we do. In the domestic market, we continue to see growth given the economic activity in the country, the continued government expenditure, and the projected GDP for this financial year. For the exports market, yes, we see a little bit of softening of orders. From our experience, the quarter, which is the last quarter of the calendar year, usually the markets around and our channel partners do inventory corrections. So this is in the last quarter of the year that we expect that. That being said, on the export side, we do see geopolitical issues continuing. Many countries are holding on to their capital investment. There are some credit issues in certain countries. There are continued being watchful about tariffs with the United States and then their own economic growth. So all of these are factors which we will have to evaluate from an export growth perspective. The inventory correction is just a 1 quarter thing which we see every year in the last quarter of calendar year.
Okay, Shweta, so given the second quarter high base now, should we expect some moderation to come in the second half, or can we expect similar momentum to continue?
Our business is very tightly linked to government infrastructure spending, the economic growth in the country, which leads to many segments growing, for example, manufacturing or let's say quick commerce and others, which require power as well as backup power. So that leads to growth for us. On the government infrastructure spending, that leads to growth in our industrial business. And then the domestic and the distribution business, which is our aftermarket. As the assets get utilized better when the economic activity is growing in the country, then that business is able to take advantage of that economic activity and high asset utilization. So if these continue to happen as we expect they will, we expect our growth to continue as well.
So growth is likely to continue and several factors continue to remain in your favor. But let's also talk about CPCB 4 Plus pricing, which you said that it has stabilized in the quarter gone by. But with rising commodity costs and higher competition, are you planning any selective price hikes as far as this particular segment is concerned, or you are solely focusing on cost control measures to protect your margins?
We are doing both. We do price corrections when commodities really change. So then we do price corrections in the market, and that is dependent on how the commodity moves and which commodity moves. So we're doing that. We also are doing continuous cost reductions on our products so that we can provide the right value to the customers in the market. And our endeavor is, of course, to hold on to our margin profile.
You've also been talking about the competitive intensity that is increasing every quarter. What levers do you have beyond cost control, product mix, localization, pricing power to protect your gross margins that's around 35 to 36%?
Our biggest leverage is that we are a global brand, well known, and been in India for 63 years. So there are customer relationships that we have for a long period of time. We manufacture here. We also, from a product perspective, focus on technology, innovation, reliability, which is very important to our customers. So we continuously listen to our customers and make sure we are tweaking our products in a way that is most beneficial to them. And we provide the value that is better than anybody can. And we, of course, lean on our innovation and technology for that. So I think those are the factors which help us lead in the market. If we reach out to our customers, those are the factors that they appreciate about us the most.
Understood. So that's as far as your gross margin is concerned. But you also, in your call, mentioned that 40% of your PowerGen revenues this quarter came in from data centers, and that this was a lumpy quarter. Do you expect this to normalize? And how much revenue are you aiming from this particular data center business going forward?
Yes, this was lumpy in this quarter. As I said, the orders and the execution all happened very well. So we do not anticipate that the data center project execution that we were able to do in this quarter to come in the next few quarters. We do see going forward in the medium term, there's a lot of opportunity in the India market for the data center business to grow. If that happens, if we see more and more global as well as local data center players playing in the market in the next year or in the next 2 to 3 years, then that could offer good business growth for us.
All right, on that note, Shweta, thank you so much for taking the time out and joining us and giving us some color on the numbers and the way forward. We'll let you go on that note. And